when you break your arm, the x-ray gives you this really simple binary answer.
Right. It's either broken or it's not.
Exactly. You look at that jagged white line on the film, the doctor points to it, and you have instant clarity. And I think we expect that exact same level of diagnostic precision from corporate earnings.
Oh, absolutely. We all do.
Right. You pull up a balance sheet, you look at the bottom line, and you just expect a clean financial x-ray. It's either profit or loss, black or red.
Yeah, but it is rarely that simple.
It never is. But today, we're looking at a $77 billion giant whose financial x-ray is hiding a massive, $1 billion internal bleed right beneath the surface.
A structural bleed, yeah.
So welcome to Talk Tickers. This is a special deep dive where our mission is to break down these dense corporate earnings calls for retail investors like you.
No jargon, just the actionable takeaways.
Exactly. Data forward, plain language, and highly actionable. Today, we are tearing into the Q2 2026 earnings call of HCA Healthcare. Ticker symbol is HCA. And honestly, this print is the absolute perfect example of why you cannot just trade off the headline numbers.
You really can't. The divergence between HCA's reported top-line metrics and the actual underlying operational reality of their hospitals this quarter, it's staggering.
It really is.
We're looking at a company that is universally viewed as the ultimate bellwether for the entire American healthcare sector. They operate over 180 hospitals.
Yeah, and thousands of care sites.
Yeah, roughly 2,400 ambulatory sites of care. So when HCA reports a shift in patient behavior or a change in, payer dynamics, it is not an isolated incident.
It's a massive red flag for the whole industry.
Exactly. It's a macroeconomic indicator for a $4 trillion industry. And what they revealed in this Q2 transcript, it indicates a fundamental fracturing of the most important profit engine in the healthcare space.
So I want to start by just throwing the headline numbers on the table, because if you only read the press release that crossed the wire at 6:00 a.m., you would think this company is firing on absolutely every single cylinder.
Oh, it looked phenomenal on paper.
Right. So for the second quarter of 2026, HCA reported diluted EPS growth of 11%, and they matched that with 11% EPS growth year to date.
Which is huge.
It's massive.
Yeah.
In a mature, really capital-intensive industry like hospital operations, seeing consistent double-digit earnings growth, that is usually a massive buy signal for Wall Street.
Yeah, and the volume metrics, they look just as robust at first glance.
Let's hit those. So same facility equivalent admissions, which is basically just the overall traffic flowing through their ecosystem, that increased by 2.7%.
Right.
But the real kicker here is the revenue yield. Net revenue per equivalent admission actually grew by 6.4%.
And those numbers, they paint a picture of just extraordinary pricing power and operational leverage.
Yep.
Because, think about it, growing your admission volume by nearly 3% is solid, but extracting 6.4% more revenue from every single one of those admissions, that is what drives outsized margin expansion.
Because the fixed costs are already covered.
Exactly. A hospital is a fixed cost business. Once you cover your baseline overhead, keeping the lights on, staffing the nurses' stations, running the HVAC, every incremental dollar of revenue drops almost straight to the bottom line.
Straight to profit.
So when you see a 6.4% bump in revenue per admission, the immediate assumption on Wall Street is that HCA is effectively managing inflation and successfully pushing rate increases onto the commercial health insurers.
But let me stop you there, because I want to reframe how we should visualize this business model for everyone listening. Because the mechanism of hospital revenue is incredibly specific.
It is, yeah.
Think of a hospital a lot like a commercial airline. You have the economy section, which in this case represents the emergency room and, uncompensated care.
The walk-ins.
Right, the walk-ins. Those patients are flying on the plane, they're taking up seats, but they're often generating very little profit. Sometimes they're even taking a loss.
I haven't taken the loss, yeah.
But the plane has to fly anyway, right? So the hospital absorbs the cost. But then you have the first-class cabin.
The profit center.
Exactly. That is the elective surgery department.
Yeah.
The scheduled knee replacements, the elective cardiac procedures, spinal fusions. Those are the passengers paying a massive premium.
A huge premium.
And the entire economic viability of the flight relies on that first-class cabin being fully booked. It literally subsidizes the rest of the plane.
That cross-subsidization is, it's the defining mechanism of the for-profit hospital model.
Right.
Because Medicare and Medicaid, they typically reimburse hospitals at or even slightly below the actual cost of providing the care.
Which is crazy to think about.
It is. And then uninsured patients often result in complete write-offs. that hits the books as uncompensated care or bad debt?
You just get nothing.
Nothing. So the only way the math works, the only way a hospital generates an 11% earnings growth rate like we just talked about, is by running a high volume of commercially insured patients through those high-margin elective surgical suites.
Because commercial insurance pays so much better.
Oh, commercial insurance pays a massive multiple of the Medicare rate. So your airline analogy is spot on. If first class is empty, the airline bleeds cash, regardless of how packed the middle seats and economy are.
Which brings us to the mathematical discrepancy that completely breaks this quarter wide open.
The paradox.
Yes, the paradox. If we look at the surgery data, HCA actually reported emergency inpatient surgeries, the trauma cases you cannot plan for, the economy seats, those were up 2%.
Right.
But elective surgeries, our first-class passengers were down 6%.
And that's not just a blip. That's an acceleration from a 2% decline last year.
Exactly. It's getting worse. Yet somehow, revenue per admission was up 6.4% and EPS was up 11%.
It doesn't make sense on the surface.
Not at all. The highly profitable procedures are vanishing, yet the company's reporting massive top-line strength. The first-class cabin is emptying out, but the airline is claiming record profits.
So to resolve that paradox, we have to look at the most critical policy shift in the healthcare sector this decade.
The ACA cliff.
Yeah, the expiration of the enhanced premium tax credits at the end of 2025. This single event triggered a payer mix shift that is wreaking absolute havoc on hospital balance sheets nationwide right now.
So break that down for us. What exactly happened with these subsidies?
Okay, so to understand the mechanism here, we have to look at how these subsidies artificially restructured the entire commercial insurance market over the last few years.
Right, going back to the pandemic.
Exactly. During the pandemic and then subsequently extended all the way through 2025, the federal government dramatically increased the subsidies available to people buying insurance on the Affordable Care Act exchanges.
The Obamacare exchanges.
Right. And the biggest thing they did was remove the income cap, meaning even middle-class families suddenly qualified for heavy subsidies.
Making comprehensive commercial insurance highly affordable for basically everyone.
Exactly. Those subsidies essentially manufactured a massive cohort of commercially insured patients entirely out of thin air.
People who previously would have just been uninsured.
Or maybe they were relying on bare bones catastrophic plans. But suddenly they had gold and silver tier ACA plans. And for a hospital like HCA, an ACA exchange plan pays commercial rates.
It was a golden goose.
It was a massive windfall for the entire hospital sector. I mean, HCA's management, along with the broader hospital lobby, they spent immense political capital trying to get those enhanced tax credits extended past 2025.
They saw the cliff coming.
They knew it was coming, but the legislative effort failed and the subsidies expired.
So what did management think was going to happen when the clock struck midnight?
Well, they went into 2026 modeling a very specific behavioral response. Their internal calculus assumed that when patients faced these massive premium spikes, because a lot of these people were seeing their monthly insurance costs triple or even quadruple overnight.
Wow. Imagine your bill quadrupling.
Right. It's a huge shock. But management assumed that about 80 to 85% of those people would find an alternative safety net.
Like getting insurance through work.
Exactly. Transitioning to employer-sponsored health plans or perhaps dropping down into Medicaid if their income's qualified.
But the data in this Q2 transcript shows that management's behavioral model was spectacularly wrong.
Completely wrong.
The migration to alternative insurance simply didn't happen. In the second quarter, HCA reported that their exchange volumes, again, the patients using those subsidized ACA plans, fell off a cliff. They declined by 15%.
Massive drop.
And simultaneously, their uninsured equivalent admissions spiked by exactly 15%.
Yeah, it was almost a perfect one-for-one swap.
Which is just terrifying if you're holding the stock.
Mm-hmm.
Why didn't people find other insurance?
Well, the behavioral economics of health insurance are notoriously sticky. I mean, when faced with a sudden drastic increase in premium costs, consumers rarely navigate the friction of finding alternative coverage immediately.
It's too confusing.
It is. If you are a gig worker, an independent contractor, or, someone caught in that coverage gap where you make too much for Medicaid but too little to afford an unsubsidized commercial premium, your most likely action is inaction.
You just freeze.
You simply drop the coverage and roll the dice. And that 15% spike in uninsured admissions, that completely confirms that reality.
Because they didn't stop getting sick?
No, of course not. They just stopped having a way to pay for it when they showed up at the hospital.
And that one-for-one swap, accounts for roughly 80% of HCA's total uninsured volume growth this quarter.
Right.
But I want to drill down into the other 20% because it points to another macro headwind that I think retail investors are totally missing.
The Medicaid issue.
Yes. The remaining 20% of that uninsured growth came from a severe slowdown in Medicaid conversions. And that was really heavily concentrated in Texas.
And we should explain what a Medicaid conversion actually is, because it's a vital financial defense mechanism for hospitals.
How does it work on the ground?
Okay, so when an uninsured patient arrives at the emergency room, the hospital's financial counselors immediately jump in. They begin screening that patient to see if they retroactively qualify for emergency Medicaid.
Oh, so they try to get them covered after the fact.
Exactly. If they qualify, the hospital can bill the state for the care, which salvages some revenue from what would otherwise be a total 100% write-off.
It's damage control.
Pure damage control. But what HCA is experiencing right now, particularly in non-expansion states like Texas, is a massive bureaucratic bottleneck and tightening eligibility requirements.
The state is just moving slower.
Slower processing, and they're approving fewer of the applications. So the hospital is left holding the bag on a much higher percentage of self-pay accounts.
And we know how self-pay accounts end up.
Yeah, they will inevitably be sent to collections and eventually written down to zero.
So this completely rewrites the fundamental pie chart of HCA's patient base. Uninsured patients now constitute over 10% of HCA's total equivalent admissions.
Double digits.
Meanwhile, the highly lucrative exchange patients have been diluted down to just 6.8%.
It's upside down.
You have 10% of your customer base consuming heavy resources. I'm talking doctors, imaging, surgical suites, ICU beds, with a near zero probability of ever actually paying the bill.
And the geographical concentration of this deterioration makes it even more concerning for the long term.
Because of the Sunbelt exposure.
Right. HCA's footprint is heavily skewed toward the Sunbelt, which, as we know, has been their primary growth engine for the last decade. But in this specific quarter, 3 specific divisions absorbed the absolute brunt of the mix shift.
The Gulf Coast Division, North Florida, and the South Atlantic Division.
Yes. In those specific markets, exchange volumes didn't just drop by the company average of 15%.
No.
They plummeted by an astonishing 25 to 28%.
Just a total collapse.
A quarter of the volume gone. Those 3 regional divisions alone generated 50% of the company's total negative impact from this payer mix shift.
The Sunbelt is effectively ground zero for the uninsured crisis.
Absolutely.
Which honestly brings us right back to our central paradox. If elective surgeries are down 6% and your Sunbelt hospitals are drowning in a 25% drop in paying exchange patients, how on earth did HCA post an 11% EPS growth?
A math doesn't math.
The operational metrics are practically screaming margin compression, but the financial statements are showing this massive expansion. It feels like a magic trick.
It is a magic trick, or more accurately, an accounting trick. The bridge between that grim operational reality and the glowing EPS print is a massive one-time accounting injection that we need to dissect very carefully.
The bailout.
The bailout. HCA managed to salvage this quarter entirely through state-level Medicaid supplemental payment programs.
Okay, let's get into the weeds here.
Specifically, they recognized approximately $400 million in incremental net benefit from these programs in Q2 alone.
So let's break down the actual mechanics of a Medicaid supplemental payment program, because this is where the quality of earnings comes under serious scrutiny for anyone looking to invest. These aren't standard payments for services rendered, right?
Far from it. These are often referred to as directed payment programs, or DPP.
DPPs, okay.
Because base Medicaid reimbursement rates are notoriously low, like we said, frequently covering only 70 to 80% of a hospital's actual cost. To provide, the care states utilize these DPPs to basically keep their healthcare infrastructure solvent.
They have to subsidize them somehow.
Yeah. The mechanics are highly complex, but essentially it works like this. A state will levy a provider tax on the hospitals within its borders.
Wait, so the state taxes the hospital?
Yes. The state pools that tax revenue and then uses it to draw down matching federal Medicaid funds from Washington.
Ah, it's a multiplier effect.
Exactly. Then the state redistributes that newly enlarged pool of capital back to the hospitals in the form of supplemental payments.
So it's a highly engineered mechanism to pull federal dollars into the state system to subsidize uncompensated care.
That is exactly what it is. It's a loophole, basically.
And the timing of these payments is where the financial x-ray we talked about at the beginning gets incredibly distorted. Out of that $400 million net benefit HCA recognized, a staggering $540 million of it came from one single newly approved program in the state of Florida.
Right. And the reason it nets down to $400 million overall is just because they had to offset it against some retroactive true-ups from 2025.
But that $540 million Florida injection was the sole reason they beat earnings expectations.
Without a doubt.
The accounting treatment is what investors must understand here.
Because it's GAAP, right?
Exactly. Under GAAP generally accepted accounting principles, a hospital cannot recognize the revenue from a state supplemental program until the exact moment the program is officially approved by the Centers for Medicare and Medicaid Services, or CMS.
Even if the hospital provided the care months or years ago.
Exactly. They cannot book the revenue until the ink is completely dry on the federal approval.
And here is the fatal flaw in the Q2 narrative that you're getting from the financial press.
Yeah.
I dug into the fine print on that Florida approval.
What did it say?
That $540 million benefit covers a 21-month period.
21 months.
Yes. It stretches retroactively all the way back from October 1st, 2024, all the way forward to June 30, 2026.
So wait, HCA took 21 months of government catch-up payments and dumped the entirety of it into a single 90-day earnings window.
That is exactly what they did.
That is wild. They used almost 2 years of retroactive subsidies to make a single quarter's EPS look like it was growing organically by 11%.
It's totally legal under GAAP,
But it's completely misleading. This isn't just masking the bleeding. It is a profound distortion of their core business trajectory.
the critique of the quality of earnings is entirely justified here. I mean, look, the cash is undeniably real.
Sure, it hits the bank account.
It fortifies the balance sheet. They can use it for share repurchases. It can fund capital expenditures. Management followed GAAP rules perfectly by recognizing it upon approval. But from a valuation standpoint, assigning a standard earnings multiple to a one-time retroactive government true-up is incredibly dangerous for retail investors.
It acts as a massive financial band-aid.
A huge one. Once you strip away that $540 million lump sum, the underlying run rate of the business is actively deteriorating. The operating leverage that usually comes with that 2.7% volume growth we saw, it was completely neutralized by the surge in uncompensated care.
The top line looks like a healthy patient sprinting a marathon, but the underlying vitals show a business on financial life support from the state of Florida.
That's a great way to put it.
And honestly, management implicitly admitted this reality when they issued their revised guidance for the back half of the year.
They had to.
Right. When you look at how they recalibrated 2026, all the optimism of the Q2 print completely vanishes.
Yeah, the revised guidance for the full year 2026 lays bare the structural damage. Let's look at the numbers. Revenue is projected between $77 billion and $79.5 billion.
Right.
Adjusted EBITDA is forecasted at $15.4 billion to $16.1 billion. Net income between $6.3 billion and $6.7 billion, with diluted EPS at $28.70 to $30.50.
On the surface, I mean, those are just colossal figures.
Massive. But the institutional analysts on the earnings call, they weren't looking at the absolute numbers. They were hyper-focused on the delta and the headwinds.
The changes from previous expectations.
Exactly. Management was forced to explicitly revise their modeling for the financial damage caused by that health insurance exchange shift we talked about. They are now projecting this specific payer mix shift will create a negative $1 billion to $1.2 billion headwind to adjusted EBITDA for the full year.
A $1.2 billion crater in their adjusted EBITDA. That is an astonishing destruction of value stemming entirely from a single legislative expiration.
One policy change.
One, when people lose their tax credits, they drop their insurance, they default to the ER, and $1.2 billion in hospital profit simply evaporates.
It really highlights the extreme leverage inherent in the hospital business model. A shift of just a few percentage points of total volume moving from a commercial exchange plan paying, say, 200% of Medicare rates down to an uninsured self-pay account yielding literally zero.
It's a violent swing.
It cascades through the income statement with violent force, And the timing of the Florida Medicaid payment just exacerbates the optics for the remainder of the year.
Because they pulled it all forward.
Right. Because management pulled that massive retroactive benefit forward into Q2, they warned analysts to expect a $100 million to $300 million headwind in the back half of the year compared to their previous run rate expectations.
So the Band-Aid gets ripped off in Q3 and Q4.
Exactly.
The supplemental payments will normalize to a standard quarterly run rate, But the exchange losses, those will continue compounding.
Month after month.
If you are CEO Sam Hazen, staring down a $1.2 billion EBITDA hole and a rapidly deteriorating Sunbelt payer mix, you have to find margin somewhere else. You have no choice.
You have to cut costs.
Which brings us to the cost side of the ledger and their so-called financial resiliency program.
Yeah, when top-line pricing power erodes due to a payer mix shift, the only lever management has left is absolute operational efficiency. The financial resiliency program is this multi-year, enterprise-wide initiative focused on stripping out redundancies.
What does that look like in practice?
They are heavily utilizing digital transformation, automating back-office revenue cycle management, optimizing supply chain logistics, consolidating shared services across the whole network.
Getting leaner.
Getting very lean. And the data actually suggests they are executing this part effectively. Same facility cost per equivalent admission was essentially flat year over year in the second quarter.
Which is impressive. Holding your per unit costs flat in an environment where medical inflation, pharmaceutical costs, and wage pressures are all still very, very real factors. That is a testament to their sheer scale.
They leverage their massive purchasing power better than almost any regional health system in the country.
But, and there's a big but here, the transcript revealed one glaring structural weak spot in their cost containment strategy that retail investors really need to understand.
Professional fees?
Professional fees.
Despite the flat overall costs, professional fees spiked dramatically. They were up 8.5% in the quarter, and they are trending toward 10% growth year to date.
That's a huge divergence from flat costs.
Huge. And this metric is critical because it exposes a vulnerability that HCA cannot simply automate away with new software. Professional fees represent the subsidies and stipends that hospitals must pay to independent physician groups to staff their facilities.
We're talking mostly about anesthesiology, radiology, and emergency medicine.
Right, exactly. The specialties where you need 24/7 coverage.
Let's talk about anesthesia, because the anesthesia shortage is one of the most fascinating microeconomic bottlenecks in the country right now.
It's wild what's happening there.
You cannot run a first-class surgical cabin without an anesthesiologist. It's impossible.
The surgeon can't operate.
Right. If you don't have anesthesia coverage, your $10 million operating room just sits idle, generating zero revenue, while all that fixed overhead continues to burn.
And the mechanics driving this specific shortage are multifaceted. First, you have a massive demographic cliff.
Retirements.
Yeah. A significant portion of practicing anesthesiologists retired during or immediately after the pandemic, and the residency pipeline is just not producing enough new board-certified physicians to replace them quickly enough.
So supply is constrained.
Very constrained. Second, and this is the really aggressive part, there has been a massive wave of private equity consolidation in the physician staffing space.
The roll-ups.
Private equity firms have rolled up hundreds of independent anesthesia practices, effectively creating localized monopolies in various markets.
And when a private equity-backed anesthesia group has a monopoly in the specific market, they have immense, absolute leverage over a hospital system like HCA.
They hold all the cards.
They can literally walk into the negotiation room and demand massive hospital subsidies just to show up and staff the ORs.
And what's compounding this leverage is the fallout from the No Surprises Act.
Oh, right. Explain how that plays into this.
Historically, if an anesthesiologist was out of network for a specific patient, they would balance bill the patient for the difference.
So the patient gets hit with a huge surprise bill weeks later.
Exactly. But the No Surprises Act made that illegal, which is great for the consumer, but it forced payers and providers into an arbitration process that has frequently resulted in lower reimbursements for the physicians themselves.
So they're making less from the insurance companies now.
Right. So to make themselves whole, these massive anesthesia groups turn around to the hospitals and demand much larger stipends to bridge the gap.
They just shift the cost burden to HCA.
Yes. Now, HCA has attempted to fight back through vertical integration. They acquired a joint venture called Valesco, which basically brought thousands of emergency room and hospitalist physicians directly onto their own payroll.
Which makes sense. Cut out the middleman.
And it has successfully stabilized costs in those specific departments. But anesthesia and radiology, those remain largely outsourced, and those PE-backed groups are extracting maximum rent from the hospital operators.
Management claims their, quote, people, process, and technology playbooks will eventually stabilize these professional fees. But the math is just brutal right now.
It doesn't add up.
If your professional fees are compounding at nearly 10% annually and your overall costs are flat, That means you are actively starving other critical areas of the hospital just to pay the anesthesiologists.
That is textbook margin compression.
Textbook. So let's synthesize the board state for a moment. HCA is facing a $1.2 billion headwind from the uninsured spike.
Right.
Their highly profitable elective surgeries are down 6%.
Yep.
And their physician subsidy costs are running extremely hot.
Burning cash.
Conventional corporate finance theory would suggest that this is the exact moment to retrench, hoard cash, delay any expansion, and just wait for the macro environment to stabilize.
Pull back on the reins.
Exactly. But HCA is doing the exact opposite.
They are playing an incredibly aggressive game of geopolitical and demographic offense right now.
It's wild.
Despite all the operational headwinds we just laid out, HCA reaffirmed their staggering capital expenditure guidance for the year at $5 billion to $5.5 billion.
Wow.
They are not pulling back a single dollar.
$5.5 billion in CapEx. What exactly are they building in the middle of a massive payer mix crisis?
They are executing a massive capacity expansion aimed squarely at the Sunbelt markets. Over the next 3 years, they plan to add between 1,000 and 1,200 new inpatient beds.
Just in the Sunbelt.
Largely, yes. But more importantly, they're rapidly expanding their ambulatory footprint. They're targeting the rollout of 250 to 300 new outpatient facilities.
Outpatient is the key word there.
Yeah, which includes freestanding emergency rooms, urgent care centers, and ambulatory surgery centers, or ASCs.
And this shift to ambulatory surgery centers is a really critical mechanism for you as an investor to understand. Procedures that historically required a 3-day inpatient hospital stay, like, total joint replacements, are increasingly being performed in these outpatient ASCs.
But technology has improved so much.
Right, so the overhead is drastically lower, the turnaround times are faster, and the margins for the operator are exceptionally high. By pushing $5.5 billion into these outpatient facilities, HCA is desperately trying to recapture the elective surgery volume that is currently bleeding out of their main hospital hubs.
It's a defensive pivot. And the broader strategy is fundamentally a demographic bet. CEO Sam Hazen was really explicit on the call regarding their internal population models. They are tracking domestic migration patterns very closely, and the data shows that the population influx into markets like Florida, Texas, Utah, Nevada, and Georgia, it's not slowing down.
People are still moving south.
In fact, management noted that current demographic trends in their core markets are matching, or in some cases even exceeding, the massive migration wave we saw during the peak of the COVID-19 pandemic.
Which is insane to think about.
So they view this $7 billion multi-year capital commitment not as discretionary spending, but as a mandatory defensive posture.
Because it's a certificate of need dynamic.
Exactly. Explain that for the listeners.
So, in many states, you have to literally prove to the government that a new hospital or surgical center is necessary before you are legally allowed to build it. It's called a certificate of need.
A CACON.
Right. So if HCA doesn't build the beds and claim the geographic territory right now while the population is arriving, a competitor will.
And lock them out forever.
Exactly. They are building the fortress right now to lock in market share for the next 3 decades, regardless of the short-term pain.
Which really brings us to the ultimate verdict on this transcript. We have dissected the headline beat, the expiration of the ACO subsidies, the mechanical shift from commercial to uninsured.
The one-for-one swap.
Right, the retroactive Florida Medicaid true-up, the $1.2 billion EBITDA crater, the anesthesia bottleneck, and now this $5.5 billion demographic gamble.
So for you, the retail investor listening right now, holding HCA in your portfolio, or maybe you're eyeing the stock after a pullback, how do we interpret all this data? Is this Q2 print a structurally bullish signal of a company brilliantly managing a difficult transition? Or is it a flashing red bearish warning sign?
Analyzing the pure mechanics of their current cash flow generation, this has to be viewed as a bearish signal in the short to medium term.
I agree.
The fundamental engine that drives outsized returns for a for-profit hospital is currently misfiring. The business model, as we discussed, requires a specific equilibrium. High margin commercial insurance subsidizing low margin Medicare and negative margin uninsured care. The expiration of those enhanced tax credits has completely shattered that equilibrium.
The first class cabin is practically empty and the standby passengers are filling up the plane.
Exactly. A one-for-one swap where a 15% drop in lucrative exchange patients translates instantly into a 15% spike in self-pay uninsured patients. that is structurally devastating.
It's unsustainable.
Operating a hospital system where 10% of your total equivalent admissions generate zero revenue is an unsustainable drag on return on invested capital. And while management definitely deserves credit for securing that $540 million Florida Medicaid injection,
It saved a quarter.
it did, but investors must strip that out of their valuation models. A 21-month retroactive government payment recognized in a single quarter is low-quality earnings.
It's noise.
It obscures the run rate reality that management themselves quantified. A $1.2 billion full-year headwind and a $100 million to $300 million deficit expected in the back half of the year. Coupling that significant margin compression with a $5.5 billion capital expenditure mandate, it severely limits their free cash flow flexibility over the next 18 months.
So if you are an investor, you simply cannot afford to trade this stock based on the top-line EPS beat that get blasted across financial news networks.
Yeah.
You just can't.
You'll get burned.
You have to monitor the underlying mechanisms. If you are holding HCA, there are two specific, actionable metrics you must track in the upcoming Q3 and Q4 prints.
What's the first one?
Number one, you have to watch the elective surgery volume. That 6% decline is the bleeding artery of this business. Management hypothesized that this drop is tied to broader macroeconomic pressures. Inflation squeezing the consumer, high interest rates, and overall affordability concerns preventing patients from paying their deductibles for scheduled procedures.
It's a consumer health issue.
Right. So if the Federal Reserve cuts rates or inflation actually cools, you need to see if that negative 6% reverses. If consumers remain stretched and those elective surgeries continue to be deferred, the margins will not recover, regardless of how much cost-cutting their financial resiliency program achieves.
The first-class cabin has to come back.
Exactly. Number two, you must track the uninsured ratio. It has breached the 10% threshold,
which is a psychological and financial barrier.
Does it plateau here as the exchange disenrollment normalizes? Or does the Medicaid redetermination process in states like Texas push that number even higher to 11 or 12%?
That would be catastrophic.
You need to see organic volume growth returning to the commercial paying side of the ledger. If HCA strings together another quarter where the only profit growth comes from retroactive state-directed payment programs, the underlying multiple will eventually compress.
It has to. The market can only ignore deteriorating unit economics for so long before it prices in the structural shift. Relying on state-level provider tax schemes to backfill lost commercial revenue is just a very precarious foundation for a $77 billion enterprise.
Which leads us to a massive overarching paradox that I think will define the healthcare sector for the rest of the decade. We just spent this entire deep dive unpacking the severe deterioration of the payer mix in the Sun Belt. The Gulf Coast, North Florida, and South Atlantic divisions saw exchange volumes collapse by nearly 30%. Texas is seeing Medicaid conversions literally grind to a halt. These markets are the absolute epicenter of the uncompensated care crisis.
And yet, these are the exact same markets where HCA is deploying the lion's share of its $5.5 billion capital expenditure budget.
Exactly.
They are pouring billions into concrete, steel, and state-of-the-art ambulatory surgical centers in the very zip codes where the insurance quality of the population is actively degrading.
Which leaves us with the ultimate question to ponder as we close out this analysis. HCA is betting its entire balance sheet on the premise that raw population growth in the Sun Belt will ultimately translate into profit growth.
Because more people equals more patients.
Right. But if the specific demographic migrating to Florida and Texas is increasingly falling into the coverage gap, losing their ACA subsidies, failing to qualify for Medicaid, and defaulting to uncompensated emergency care, how long can a hospital operator continue to build billion-dollar expansions?
It really tests the limits of the cross-subsidization model. I mean, you can build the most advanced surgical suites in the world to capture the inbound population, but if the first-class cabin vanishes completely, the sheer weight of the uninsured volume will eventually force a fundamental redesign of how healthcare is financed in these high-growth regions.
You just cannot build a five-star restaurant for a neighborhood that can no longer afford to pay the check, no matter how many people move onto the block.
That is perfectly said.
That demographic collision is the true story hidden beneath the 11% EPS growth. And it is the reality every healthcare investor must navigate moving forward. Thank you for joining us on this edition of Talk Tickers. Keep looking past the headlines, keep demanding clarity from the balance sheet, and we will catch you on the next deep dive.